Look, I need to show you something that's happening right now in the silver market that most people are completely missing. And if you own physical silver or you've been thinking about it, what I'm about to walk you through could be the difference between catching one of the biggest moves we've seen in decades and watching it happen from the sidelines. Because here's what's actually going on. While everyone's been focused on gold hitting new all-time highs, silver's been sitting there, coiled like a spring, building pressure in ways that historically have led to explosive moves. And I'm not talking about modest gains. I'm talking about the kind of moves where silver doubles, triples, or more in a compressed time frame. We've seen it before. 1979 to 1980, 2010 to 2011, and the setup we're looking at right now has characteristics of both those periods, but with additional factors that didn't exist back then. Let me start with what's happening on the supply side, because this is where the story gets really interesting. Global silver mine production peaked back in 2016 at about 900 million ounces. Since then, we've been in decline. We're now producing around 830 million ounces annually from primary silver mines. That's a 70 million ounce deficit just from the production decline. But here's where it gets critical. Silver isn't like gold. About 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When those base metal prices are weak, or when those mines become uneconomical, silver production drops as a consequence. We're seeing that right now with several major copper projects being delayed or scaled back due to permitting issues, environmental concerns, and rising costs. Meanwhile, demand is absolutely exploding. Industrial demand for silver hit a record 690 million ounces last year. Solar panels alone are consuming over 200 million ounces annually, and that number is projected to reach 300 million ounces by 2027 as countries race to meet renewable energy targets. Every solar panel requires about 20 grams of silver. China's installing solar capacity at a pace that's frankly hard to comprehend. They added 216 gigawatts of solar in 2023. To put that in perspective, that's more than the entire installed solar capacity of the United States. And they're not slowing down. Their 2024 targets are even higher. But solar is just one piece. Electric vehicles use 2 to 3 times more silver than traditional cars. 5G infrastructure requires significantly more silver than 4G. The electronics boom, the push toward electrification, the expansion of data centers for AI, all of this requires silver. We're talking about structural, long-term demand that isn't going away. This isn't speculative. This is industrial consumption that's baked into the global economic transition that every major economy is committed to. Now let's talk about what's happening with physical silver inventories, because this is where things get really tight. Comex silver inventories, the registered category that's actually available for delivery, has been hovering around 40 to 50 million ounces. That sounds like a lot until you realize that industrial users consume that much silver in about 3 weeks. 3 weeks. The entire available Comex inventory would satisfy global industrial demand for less than a month. We've never seen inventory levels this tight relative to demand in the modern era. And here's what makes this even more precarious. The London Bullion Market Association vaults, which hold the majority of institutional silver, have seen significant drawdowns over the past 2 years. We're talking about hundreds of millions of ounces leaving those vaults. Where's it going? Some of it's going to India, which has become a massive physical silver buyer. Some of it's going into industrial consumption. And some of it's going into private hands, people who are taking delivery and holding it outside the banking system. Once silver moves into industrial use, it's gone. It's not coming back. Unlike gold, which gets recycled at high rates because of its value, silver gets consumed in applications where it's not economical to recover. It's used in tiny amounts spread across millions of products. That silver is effectively removed from the available supply forever. Let me tell you what happened in 2011, because there are some eerie parallels to what we're seeing now. Silver started 2011 around $30 an ounce. By April, it had rocketed to $49. That's a 63% gain in 4 months. What drove that move? It was a combination of factors. You had massive investment demand coming in through ETFs. You had concerns about currency debasement after years of quantitative easing following the 2008 financial crisis. You had supply concerns. And you had a short squeeze on the Comex, where industrial users and investors were demanding physical delivery, and the available supply was getting tight. But here's what's different now. In 2011, we didn't have the structural industrial demand we have today. Solar was a fraction of what it is now. Electric vehicles were barely a thing. 5G didn't exist. The industrial demand picture is fundamentally stronger today than it was then. And yet silver is trading at $31, barely above where it was at the start of that 2011 run. Think about that. We have stronger fundamentals, tighter supply, exploding industrial demand, and silver is at essentially the same price it was 14 years ago. Meanwhile, gold has gone from $1,400 to over $2,700. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting around 85 to 1. Historically, that ratio averages around 60 to 1. When it gets stretched to these levels, silver tends to snap back violently. Let me walk you through what happened in 1979 and 1980, because this is the move that everyone in the silver market knows about. Silver started 1979 at around $6 an ounce. By January 1980, it had hit $50. That's more than an 8x move in about a year. What caused that? The Hunt brothers were trying to corner the silver market, sure, but that wasn't the whole story. You had double-digit inflation. You had a collapsing dollar. You had geopolitical instability with the Iranian Revolution and the Soviet invasion of Afghanistan. You had a loss of confidence in fiat currency. People were fleeing into hard assets. Silver, being more accessible than gold for average investors, became the vehicle of choice for people trying to protect their wealth. Now, I'm not saying we're going to see silver go to $50 in the next year. I'm not making price predictions. But I am saying that the conditions we're looking at right now, the supply deficit, the industrial demand surge, the monetary instability, the geopolitical tensions, these are the kinds of conditions that have historically preceded major moves in silver. And when silver moves, it doesn't move gradually. It moves in sharp, explosive bursts that catch most people off guard. Let's talk about what's happening with the US dollar, because this is a critical piece of the puzzle. The dollar index has been under pressure as countries around the world are actively working to reduce their dependence on the dollar for international trade. The BRICS nations, Brazil, Russia, India, China, South Africa, have been expanding their alliance and explicitly discussing alternatives to dollar-based trade. Saudi Arabia, which has priced oil exclusively in dollars since 1974, has been in talks with China about accepting yuan for oil payments. That's a seismic shift. The petrodollar system has been a cornerstone of dollar dominance for 50 years. If that starts to crack, the implications for the dollar are profound. And here's why that matters for silver. When confidence in fiat currency declines, people move into tangible assets. Gold and silver have been money for thousands of years. They can't be printed. They can't be debased. They have intrinsic value. We're seeing central banks around the world buying gold at record levels. They added over 1,000 tons to their reserves last year. That's the highest level of central bank gold buying in decades. They're diversifying away from dollars and into hard assets. If central banks, the most sophisticated financial institutions in the world, are doing this, what does that tell you about their confidence in the current monetary system? Now, here's something most people don't understand about the silver market. The paper silver market, the futures and derivatives traded on exchanges, is massive compared to the physical market. For every ounce of physical silver, there are estimated to be 100 to 250 ounces of paper silver claims. That's not unusual in commodity markets, but it creates a situation where if a significant portion of paper silver holders decide they want physical delivery, the system can't handle it. We saw glimpses of this in 2021 during the Reddit silver squeeze. Premiums on physical silver coins and bars exploded. Dealers were sold out. Delivery times stretched to weeks or months. And that was just from a relatively small surge in retail demand. Imagine what happens if institutional players start demanding physical delivery in size. Let me tell you about what's happening in China, because this is a story that's not getting enough attention. China is the world's largest silver producer and also the largest consumer. They produce about 3,600 tons of silver annually and consume about 6,000 tons. They're a massive net importer. But here's what's interesting. Chinese investors have been accumulating physical silver at unprecedented rates. Sales of silver pandas, the Chinese silver bullion coin, have been breaking records. Chinese silver ETFs have seen massive inflows, and there are reports of large-scale physical silver purchases being made by Chinese institutions and wealthy individuals. Why? Because they see the same supply-demand dynamics we're talking about. They see the industrial demand growth. They see the monetary instability. And they're positioning themselves ahead of what they believe is coming. Quick aside here, because this is relevant if you're thinking about your own financial security. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, there's a way to get physical precious metals into those accounts without triggering taxes or penalties. It's called a gold IRA. And it works with silver too. I put together a free guide that walks through exactly how this works, what the rules are, how to find a reputable custodian, all of that. It's in the description below. Worth checking out if you're concerned about the long-term value of paper assets and want some tangible wealth protection in your retirement portfolio. No pressure, just something to be aware of. Anyway, back to what's happening in the market right now. Let's talk about the Comex, because this is where the rubber meets the road for silver pricing. The Comex is where silver futures are traded, and it's the primary price discovery mechanism for the global silver market. But here's the thing. The Comex operates on a fractional reserve system. They don't have enough physical silver in their vaults to cover all the outstanding contracts if everyone demanded delivery. They're counting on the fact that most traders are speculators who will close their positions before delivery. But what happens when that assumption breaks down? We've seen stress in the Comex silver market multiple times over the past few years. In March 2020, during the COVID panic, the spread between Comex silver futures and physical silver prices blew out to unprecedented levels. Futures were trading at $12, while physical silver coins were selling for $20 or more, if you could even find them. That's a massive dislocation. It showed that the paper price and the physical price can diverge significantly when there's stress in the system. And we're seeing signs of that stress building again. Premiums on physical silver products have been elevated for months. Delivery times are longer than normal. Dealers are reporting strong demand and tight supply. Here's what I find fascinating about the current setup. Silver mining companies, the actual producers of silver, are trading at valuations that suggest silver is going to stay at current levels or decline. Their stock prices are depressed. Their price-to-earnings ratios are low. The market is pricing in no growth, no increase in silver prices. But if you look at what those companies are actually doing, they're expanding production, investing in new projects, and positioning themselves for higher silver prices. There's a disconnect between what the equity market is pricing in and what the companies themselves are preparing for. That kind of disconnect doesn't last forever. Eventually, reality catches up. Let me walk you through the math on the supply deficit, because this is important to understand. Global silver supply from mining and recycling is about 1 billion ounces per year. Global demand from industrial use, jewelry, silverware, and investment is about 1.2 billion ounces per year. That's a 200 million ounce annual deficit. Where's that deficit being filled from? Above ground inventories, existing stockpiles. But those stockpiles aren't infinite. The Silver Institute estimates that identifiable above ground silver inventories are around 2 to 3 billion ounces. At a 200 million ounce annual draw, we're talking about 10 to 15 years before those inventories are depleted. But it doesn't work that way in practice. As inventories get tighter, prices rise. As prices rise, some demand gets destroyed, and some supply gets incentivized. But the point is, we're in a structural deficit that's drawing down finite inventories. That's not sustainable long term. And here's where the geopolitical situation adds another layer. Russia is one of the world's largest silver producers. Sanctions and trade restrictions have disrupted normal silver flows from Russia to Western markets. That's removed supply from the market. At the same time, Russia has been a major buyer of gold and silver for its reserves as part of its de-dollarization strategy. So you have a major producer that's both restricted from exporting to certain markets and also buying for its own reserves. That's a double hit to available supply. Let's talk about what happened in 2020 and 2021, because this is recent history that's very instructive. When COVID hit, and governments around the world started printing money at unprecedented levels, trillions of dollars in stimulus, people started looking for inflation hedges. Silver went from $12 in March 2020 to $30 by August 2020. That's a 150% move in 5 months. Then, in early 2021, the Reddit Wall Street Bets community targeted silver, trying to create a short squeeze. Silver spiked to $30 again, and physical premiums went through the roof. You couldn't buy silver eagles or bars at anywhere near spot price. Premiums were $10, $12, $15 over spot. That showed the fragility of the physical market. When demand surges, the system can't handle it. But here's what's different now compared to 2021. Back then, it was primarily retail investors driving demand. This time, we're seeing institutional interest. We're seeing industrial users getting concerned about supply security and building inventories. We're seeing sovereign wealth funds and central banks diversifying into silver. We're seeing major investment funds launching silver-focused strategies. This is broader-based, more fundamental demand. It's not just a speculative squeeze. It's a recognition that silver is undervalued relative to its supply-demand fundamentals and its role in the global economic transition. Think about the energy transition that every major economy is committed to. The European Union has mandated net zero emissions by 2050. The United States has similar targets. China has committed to peak emissions by 2030 and net zero by 2060. Achieving those targets requires massive deployment of solar panels, wind turbines, electric vehicles, battery storage, and grid infrastructure. All of that requires silver. The Silver Institute projects that silver demand for solar panels alone could reach 400 million ounces annually by 2030. That's nearly half of current total global silver supply just for one application. Where's that silver going to come from? Mine production isn't growing fast enough. Recycling can't fill the gap. The only way to balance the market is through higher prices that incentivize new supply and ration demand. Let me tell you about what's happening with silver ETFs, because this is another piece of the puzzle. The largest silver ETF, SLV, holds about 450 million ounces of physical silver. That's a massive amount. But here's what's interesting. Over the past year, we've seen periods of significant inflows into silver ETFs, indicating institutional buying, followed by periods of outflows. But the outflows haven't been as large as the inflows. Net-net, institutions are accumulating, and when you look at the options market on silver ETFs, there's been a notable increase in call option buying, particularly out-of-the-money calls betting on significant price increases. That's not retail investors. That's sophisticated money positioning for a move. Now let's talk about inflation, because this is the elephant in the room. Official inflation numbers have come down from their peaks, but if you look at the methodology used to calculate CPI, it's been changed multiple times over the decades in ways that understate true inflation. If you calculated inflation using the methodology from the 1980s, we'd be looking at double-digit inflation right now. Food prices, energy prices, housing costs, insurance, healthcare, all of these are significantly higher than they were a few years ago, and they're not coming back down. The money that was printed during COVID is still in the system. The government debt is at record levels and growing. The only way to service that debt without default is through inflation, devaluing the currency so the debt can be paid back with cheaper dollars. That's the playbook. And in that environment, hard assets like silver are a store of value. Here's something that doesn't get talked about enough. Silver has a unique position as both an industrial metal and a monetary metal. Gold is primarily monetary. Copper is primarily industrial. Silver is both. That gives it a dual demand profile. When the economy is strong, industrial demand drives silver prices. When there's monetary instability, investment demand drives silver prices. Right now, we have both. We have strong industrial demand from the energy transition and electrification, and we have growing monetary concerns from currency debasement and geopolitical instability. That's a powerful combination. Let me walk you through what a supply squeeze looks like, because if we get one in silver, it's going to move fast. In a supply squeeze, you have more demand for physical delivery than there is available supply. Prices start rising. As prices rise, short sellers who have sold futures contracts betting on lower prices start getting squeezed. They need to either deliver physical silver or buy back their contracts at higher prices. That buying pressure pushes prices even higher. Meanwhile, industrial users who need silver for production start panic buying, worried about supply availability. That adds more demand. Investors see prices rising and jump in, not wanting to miss the move. That adds even more demand. It becomes a self-reinforcing cycle. Prices can move 20%, 30%, 50% in a matter of weeks or even days. We've seen it before in silver. We'll see it again. And here's why I think the next move could be bigger than previous ones. The structural industrial demand is higher than it's ever been. The supply deficit is real and growing. The monetary instability is global, not just in one country or region. The geopolitical tensions are multifaceted, with conflicts, trade wars, and a fracturing of the post-World War II global order. And the awareness of silver's role in the energy transition is growing. More people understand that silver isn't just a shiny metal. It's a critical industrial commodity that's essential for the technologies we're building our future on. Think about what happens if we get a real currency crisis. Not just inflation, but a loss of confidence in the dollar or other major currencies. People will flee into tangible assets. Gold will be the first stop, but gold is expensive. An ounce of gold is nearly $3,000. That's out of reach for a lot of people. Silver, at $31 an ounce, is accessible. You can buy a few ounces with a few $100s. If we see a rush into precious metals by the general public, silver is going to be the vehicle of choice for most people. And the physical market can't handle that kind of demand. There isn't enough supply. Premiums will explode. Delivery times will stretch to months. and the price will have to rise to ration the available supply. Now, I want to be clear about something. I'm not saying silver is going to the moon tomorrow. Markets don't move in straight lines. There will be volatility, there will be pullbacks, but the long-term trajectory based on the fundamentals we're looking at is higher, significantly higher. And if you own physical silver, the key is to hold through the volatility. Don't get shaken out by short-term price swings. Understand why you own it. You own it because it's a tangible asset with intrinsic value. You own it because it's a hedge against currency debasement. You own it because it's a critical industrial commodity in a structural supply deficit. Those reasons don't change because the price drops 10% in a week. Let me tell you what smart money is doing. They're accumulating physical silver quietly. They're not chasing price. They're buying on dips. They're taking delivery and storing it securely. They're thinking in terms of years, not months. They understand that the setup we're looking at doesn't resolve quickly. It takes time for supply deficits to manifest in price. It takes time for monetary instability to drive investment demand. But when it happens fast. And if you're not positioned ahead of time, you miss it. Here's the bottom line. If you own physical silver, don't let short-term price action shake your conviction. Understand the bigger picture. We're in a structural supply deficit. Industrial demand is exploding. Monetary instability is growing. Geopolitical tensions are rising. Inventories are tight. The paper market is over-leveraged. These are the conditions that precede major moves in silver. You're positioned for what's coming. Hold your position. If you don't own silver yet, but you've been thinking about it, understand that we're still early in this cycle. Silver is still historically cheap relative to gold. It's still undervalued relative to its supply-demand fundamentals. The opportunity is still there. But windows don't stay open forever. At some point, the market wakes up to what's happening, and prices adjust rapidly. You want to be positioned before that happens, not after. What happens next in silver is going to be determined by how these factors play out. The supply deficit, the industrial demand growth, the monetary instability, the geopolitical tensions, the tightness in physical inventories. All of these are building pressure. And when that pressure releases, silver is going to move. The question isn't if, it's when. And if you own physical silver, you're positioned for it. Stay informed, watch the fundamentals, and hold your position. Because what's coming could be one of the most significant moves we've seen in the silver market in decades.